Good morning. It is Tuesday. It is the Bubba Show. And as we've been doing a couple of special features. And this week, I think we'll do today why the bulls are pissed off or why the bulls are upset. You know, you've had a market that has now gone up 23% since November. We have not had any bit of any correction since this latest leg of the bull market has started. So what could possibly upset the bulls? Well, the first thing that upsets the bulls is they're not long enough. They don't own enough equity. And that is always a concern, you know, and this is one of the reasons that the market continues to go higher here, is because you still have, what you have here now is the late money that didn't participate at all in this rally. That's coming in to buy. You have the bulls who feel that they didn't invest enough, so they're coming in to buy. So they're upset because they didn't have a big enough position, because nobody wanted to believe the tape and nobody wanted to believe the rally. So what happens is people did not invest as much as they thought they should have. So what you're starting to see here is what we have, what's looking as a little bit as a blow off to the upside, because now the money is really coming in to chase this market. But there are many signs that can create some warning here. But again, the bulls are upset because they didn't participate enough. People that would normally be 100% invested might only be 60% invested in the market because they didn't trust the technical read of the market. This is why human opinion and emotion should not be calculated into when you're trading. The reason that we use stops to take us out of the market is so we don't have to be involved in a decision process of where we're upset. If we follow the footprints of the market, and the market has been bullish, so if you're following the footprints of the individual issues that you're trading, someone up, someone down, you allow yourself the ability to go ahead and make that trade. So the big funds are upset, and now they're flying in and pouring in money here because they think that they missed it and they think it can go forever. Now we know for sure that at some point here there is going to be a correction. I guarantee it. I will stand by it. I am one of the few who is not putting new money into this market. And I'm talking about, when you talk about new money, we're talking about long-term money. We're not talking about making a trade, as many of us do, in and out during the day, or in and out over a swing period of time. What we're talking about is what you would be putting in your IRA money, your 401k. Any of that money should not be new now. Let the markets finish the cycle that they're in, and then when we do get a sell-off, we can then look to bring some new money back in when we get good solid technical levels. But again, your focus here is on the footprints that the market leaves and what it's telling you. I'm saying here is the point to observe the market, observe and protect your capital. Whatever you're in, move stops in, let it come back to you, and then we'll look for new opportunity. Other than that, I don't see any real reason to jump in here, because what's going to happen is that when the last of the chasers get in here, you can expect a pretty good correction after that happens. When it will happen, we don't have the answer, but we're going to look for it. Remember, the Monday Average Joe Options Call, would love to see you there. If you want to find out more about it, email me at todd@averagejoeoptions.com. For Tuesday, the Bubba Show, we'll talk to you on Wednesday.